Well, it looks as though we're live on Facebook and YouTube and LinkedIn. And hi to everybody, it's Paul Archer here. So let's just come on camera because it's the right thing to do, isn't it? Apart from that little holding slide that we've done just to get things moving along. Welcome to my mortgage live stream. Welcome to everybody. Hello to all of you, and good to see you again. And thanks for either listening live or listening to the recording or listening to the podcast or whatever you want to do. It's great to have you here on Monday morning because it's all things mortgages for you. Now, I've been having a few emails this week asking a few questions. So I thought I'd kick off by answering those emails via the live stream. But I'd also like to pick up on some of the FCA stuff as well. We've got a bit of a series going, haven't we, on the FCA and the impact on regulations, because that all goes into our boot camp. You see, all the HD versions go into our CMAP boot camp, which is proving extremely popular this year. Lots and lots of people realizing that just reading text on the screen ain't much of an e-learning, really. So, the video that we do is all very, very popular. Enough of that. Let's get down to some action, shall we? Very interesting question from one of the guys on YouTube, actually. Thank you for responding. Whenever people comment on YouTube, I always try and get back to people as quickly as I possibly can. And the chap emailed about the affordability rules. As you know, of course, the mortgage affordability rulings are being looked at this year. At the moment, it's getting a lot of peer review, and all the association people are all putting their sort of toothpenny worth in. And that's the right thing to do. And one question came from the guy on YouTube about affordability. If it allows first-time buyers to borrow more money, which it probably will do, won't that have an impact on house prices? Surely house prices are high enough as they are. The fact is, yeah, it probably will. But that's actually not the fault of affordability. So let's just take a look at how house prices in this lovely country of ours are actually created and how they have been booming over the last 20, 25 years. In fact, house prices have been booming since the 70s. People forget that the first house price boom was in 1971, I think it was. I was only about 10, 8, 9, something like that at the time. And it boomed. House prices rocketed then. People don't realize that. Then we had another boom in the 80s. And house prices have always gone up. So why does that happen? Well, what we need to do is take a look at the economics of supply and demand. So let's head over to a whiteboard. I got a second whiteboard in the studio now, which I'm using to help you to understand this kind of stuff. So I just want to talk to that camera there, because that camera is hitting this whiteboard. Now, every price of everything is geared towards supply and demand. In a market economy where you don't have a lot of government subsidy, arguably, do we have government subsidy in the mortgage market? Well, stamp duty is a tax. It was relieved during the pandemic, and that had an effect. But at the end of the day, you have demand. So let's just put demand in there for you. You have demand for houses to buy property. And then, of course, you have supply. There you go. Now, the supply and the demand rests at a certain equilibrium, and that's what causes prices of houses to go up or go down. Simply put, if demand's high and supply is low, prices go up. Now, the problem with this country is the supply of property is, well, it's pretty limited, isn't it, really? So, we've got property here in the UK, and supply is limited. Why? Well, first of all, we don't have a lot of land. We are actually one of the highest density population countries in the world. Not a lot of people know that. I think it's kind of Hong Kong or Singapore, which it is, of course. But the UK has quite a few million people. What have we got? 68, 69, 70 million people now. And the land that we live in is not that big, particularly when you sort of see most of the population tends to be in central England, southeast England, London. So we haven't actually got a lot of land to build new houses. We've got some really strict planning laws, green belts, and all sorts of local laws that stop builders from building. It's changing. It's being improved. The government, for example, has made it easier to convert office dwellings, sort of light commercial, into residential now. And there's plenty of money to do that. So there's a lot of new building going on now. They reckon we need 200, 300,000 properties built every year just to maintain the status quo. I don't know about that. The fact is, supply of homes is limited. Now, if you take the demand for homes, that is the thing that varies massively. At the moment, we've got lots of demand. The mortgage market's doing well. The pandemic has kind of put a focus on people's houses. People want gardens and extra rooms and stuff like that now, don't they? And people are moving now because they're thinking, well, we spend more time at home now. We spend time, we used to be in the office, we're now at home. Let's get a nice property. And of course, mortgage interest rates are very low, have been for donkey's years now. Crikey, they've been very low since the financial crash, really. Even before then, they weren't that high. So the cost of mortgages is very low. Now, the provision of mortgages, in other words, how easy is a mortgage to get, that's the problem at the moment. Now, not everybody, of course, that buys a house needs a mortgage. Most people do. And if you can get a mortgage, then it helps you to buy a house. So if you make getting mortgages easier, then you will increase demand, because you will, won't you? And if you increase demand and limit supply, prices go up. That's the way it is. That's how housing works. So there's all sorts of issues going on here. But the question was, if you make affordability easier, in other words, the average first-time buyer can borrow more money, then they will be able to buy a property rather than rent. It's simple as that. If they're able to get a mortgage to buy a property, that's going to increase demand. And increasing demand, of course, with a contracted supply, will put prices up. So yeah, these affordability changes will put prices up to a certain degree, but you've got to look at the whole equilibrium, really. My son Lewis, for example, he's looking to get a place of his own now. His mum's kicking him out. He's 27, about time too. And he's having an easy life, you see. And he was on Zoom with me the other day. We were looking at house buying and mortgages. He can't get a mortgage. He's on a good salary. He still can't get a mortgage to buy a property. He can't get enough. He hasn't quite got the deposit either, which doesn't help, but he hasn't got enough money to get a mortgage. So he'll rent, which is fine. He'll rent and be very happy doing that. If, however, the affordability rules were changed, it may well be that Lewis could get the mortgage he wants, which means he will then buy. But of course, that means that the rental sector will change, because so many people that would have rented are now able to buy. Of course, that will then push the price of rent down. And it might actually get landlords to flog their properties when they see that there's actually no mileage anymore in renting out properties. So you might actually see supply increase as a result of this affordability. So you can't really say that one thing affects everything, because it's all mixed into the mixing bowl, and everything affects everything. But that's purely simply how house prices work, really, supply and demand. And mortgages, of course, help people to buy homes. That's the key thing. But there's many other factors. I thought it was a really good question, actually, from our bootcamper friend. So thank you very much for sending in that question. Now, I've got a couple more questions came in, so let's get some details of these, because these are fascinating questions that came down. Now, this next question was a result of my article a couple of weeks ago on bridging finance and development finance, and I painted a case study of somebody buying a rundown property, with about sort of 12 bedrooms, and doing it all up and making it into a great big house of multiple occupation for rent. And many mortgage advisors looked at that and thought, cool, that's a good market to get into. And they were very, very surprised how fairly easy it is to get development finance, financing, bridging, buying on auctions, and then obviously remortgaging for buy-to-lets as well. It's a specialist area, and one which a lot of good brokers are involved in, but not every mortgage advisor really understands it. Of course, the answer to that one is that there's a lot of money awash. There's a lot of money available to lend. Bridging companies, the likes of MT, Octane Capital, Ocean, they're not household names. They're damn good companies. They got a lot of money, and they're very keen to lend this money to developers and landlords to buy property. So there's plenty of money as well. And it's good security for these lenders, getting the property, getting it done up beautifully, developed, and then converted into rental or maybe sold on. It's great lending. So it is a marketplace that mortgage advisors should really consider if you're wanting to move over to different areas of expertise. Don't just rely on the old-fashioned first-time buyer, buying property, mortgage with Santander. That's not where it's at. If you want to get really into the broking world, then bridging, second charge, all those good things are easy to obtain. Well, not easy, but you do need to understand the marketplace. So that was a great little question that came back from my boot camper on that one. And the final question, actually, which was a very interesting question as well. I'll just head over here to get this whiteboard wiped off for the next one. The final question really was from somebody who's interested in equity release. And she's very interested in equity release, and she came back to me and said, "Look, I've enjoyed your presentation on equity release, and I'm quite keen to get into that marketplace, but I'm worried about the marketplace. Are we due for a recession?" was her question. If so, do I need to hunker down and get involved in different business areas? And I thought it was an interesting question as well. Are we due for a recession? Is the question to ask you. Are we on par for a big fat recession? I don't know if we are. Let's just make a note of that on the whiteboard, shall we? Because we need to understand this kind of stuff for CMAP, don't we? The recession, the economy. And besides, customers will start to ask this: are we due a recession? Now, the thing about recessions is I don't think we are due a recession for a year or so yet, because the economy is not overheating. Yes, we've got inflation. Inflation's on the way up. So we know that inflation's on the way up. We've seen the figures for CPI, and it's not looking particularly rosy, is it? But of course, that is not caused by an overheated economy. Typically, inflation is caused by an economy that's overheating. In other words, demand and activity is just too much for the economy to cope with. Therefore, prices are going up to compensate for that. We ain't got that yet. We may do. But at the moment, inflation's been caused by the supply side. Again, demand and supply, isn't it? Supply of products and services to our economy are being throttled, particularly on the energy side. We've got a potential war possibly in Eastern Europe. We've got gas prices, energy prices rocketing. We've got supply issues. We've got container ships doubling in price. The products that we used to get over and import in for cheap, if you like, are no longer cheap anymore. In the Far East, they have different issues with COVID as well. So supply is the problem. Now, that's going to iron itself out in the next year or so. So I think inflation will start to trickle down. Obviously, interest rates are going up to compensate for that. Whether that's a knee-jerk reaction from the Bank of England, I don't know. But they're putting up interest rates to try and combat inflation. I don't think the problem with inflation is, as I say, demand. So do we need to contract the money supply to offset inflation? I don't think we do. We'll be careful with that. But anyway, that's politics, isn't it? But are we due for a recession? Well, a recession, remember, is where you have a drop in activity in the economy. It's measured by gross domestic product, GDP, being like negative for 2 quarters. Now, back in COVID, of course, from the period 2020 to 22, which is pretty much COVID time, isn't it? Now, whether we're over that or not, I don't really know. There's all talk that we are. Now, during COVID, of course, we saw a massive drop in GDP because the government shut the country down. So you're going to have a drop. Back in 2020, we saw like 10, 12% drop in GDP or whatever the figures were. Now, that's because the economy stopped. Now, the government kept the economy on a life support system, with furlough payments, etc. We kept it going along. It cost us £300 billion, but, that's what we did. So although we theoretically had a recession, we didn't. And things are back to normal now. They're back to what they were before. And the economy is starting to really get going again. There's lots of activity, lots of excitement in the economy. The financial services sector, the mortgage sector is doing really well. And other sectors are too. Now, this may well cause overheating in a couple of years' time. I think we were due a recession in 2020. We were due one, all the signs were there, but COVID came along and kind of just froze everything. So I think in a couple of years' time, we may be heading towards some kind of recession. So as a mortgage broker, mortgage advisor, you need to think about that. You need to plan for that. And that's essential to any role of a mortgage advisor. If you're running a business or any kind of business, you need to be aware that maybe a recession in a couple of years' time. What happens with recessions? Well, quite simply, what happens with recessions is the economy is contracted. Things stop being sold, things stop being bought, people don't have as much money in their pockets. If inflation doesn't get tamed, that might even make it even worse. But I think that will be sorted in a year or so's time. So as a mortgage advisor, then, you need to be aware of what you can do that will help your business. And that's where you need to start segueing across now. If you like diversifying, I've talked about diversification all the time. A lot of people that just get mortgage qualified, for example, all they're doing is they're just lending mortgages, but they're doing a lot of good mortgages and they're earning a good proc fee from a mortgage, which is not a difficult thing to do. And they're getting a good proc fee and it's working well for them. Now, some good ones are also doing protection. And with protection, you're earning a good commission, and that might be home insurance as well. Again, that's geared towards the mortgage market and the housing market. Now, if you were to segue over to things like, and I've talked about this before, equity release, for example. Equity release is recession-proof because people taking out equity release mortgages don't need a job, do they? They're not earning, they're usually retired. So because that's unaffected by the recession. And they may want to raise money for a particular purpose. So equity release is a good one as well. Get into remortgages, get into wills, LPAs, wills, lasting powers of attorney. You might want to get into long-term care. Somebody was talking about long-term care the other day, one of my boot campers. Long-term care is a different marketplace altogether. That's not to do with mortgages. It's connected to protection and equity release. Maybe even debt management consultancy. All sorts of areas that a mortgage advisor, mortgage broker can help with. Ultimately, if I were in your shoes, I would look at wealth management, not putting money under funds under management, because computers are doing that now. You don't need humans so much anymore for that. That gravy train's coming to an end. Now, I'm talking about people who are retiring, who've got these big pension pots. They need advice around those. They need some ideas and advice and guidance around what to do with these big pension pots on retirement. That links in nicely with equity release, of course, and also to a degree wills and LPAs and maybe even long-term care. So that may be an area that you might want to look into. If you want to get into that world, then you have to change your permissions. And I've got a little session now for 5 minutes. I'm going to finish off this live stream, which will show you how you can get permission to do these things. So there you are, there's a message. Are we due for a recession? I think the UK economy has got plenty of capacity at the moment for growth. I really do. We've got pent-up demand. We've got people all in employment. We've got businesses well-fueled, well capital injected. I think we've got a good 2-3 years of a booming economy, and then we might look at some kind of recession then. But hey, I don't have a crystal ball, so I don't know, do I? Anyway, let's move away from there then. We'll say farewell to that one. I promise you we do a little session now on your permissions as a mortgage advisor. Now, this is going to go into the boot camp. The CMAP boot camp's got all of these recordings in there, which helps you to study and take the exam. So I want to give you a little bit of update on that section. So let's go over to a slide for this one. So let's just ping over and we'll get a little slide going, shall we? So let's get rid of the white there. FCA and integrity of the system is first of all what I want to take a look at. In fact, I think we'll look at that one next time. Why don't we go on to that one about authorization and regulation? I like that one. So I'm going to change the slide there for you because I want to talk about this one, authorization and regulation, which is a great topic really when it comes to it. Authorization and regulation. We call this kind of supervising firms, don't we? And getting involved in how firms operate. Because at the end of the day, the FCA are the people that regulate us and get us involved. So let's talk about this, shall we? Let's get into this area. And what I'm going to do, just because I can, I'm going to pop in and say hello to you. So let's bring me into the slides. FCA authorization and regulation. Now, I talked earlier about good mortgage brokers, mortgage advisors, moving into different business areas. Now, if you're going to do that, you've got to get your permissions sorted. Now, the FCA authorize and regulate firms. The PRA do as well. They authorize biggies, big firms, but your average mortgage advisor, mortgage broker will be connected to the FCA because they get authorized and they get their conduct rules regulated by the FCA themselves. So let's take a look at some of the areas which are regulated, the types of advice that are regulated. Give you some ideas about these. Got a nice little graphic here for you, which talks to you about regulated activities. Now, for each of these activities, you need special permissions from the FCA to get permission to do it. So first at the top here, I've got accepting deposits. So if you're in a banking situation and you accept deposits, you need permission, if you like, to get involved in that activity. Obviously, mortgage brokers don't do that to you. You're not getting involved there, are you? Running insurance contracts. Now, this is the running of them. This is the insurance company side of things. They actually deal with this themselves. Again, insurance companies will run and create insurance contracts as well. Advising on insurance is an area that many of us get involved in. But that's actually ICOBs, or insurance conduct of business rules. So if you only get involved in insurance advising, that's a separate permission. But most mortgage advisors, mortgage brokers also get involved in that area. Key on that. Dealing with investments, of course, this is dealing, this is not advising. So that's handling investment products, which is way outside of our marketplace. Managing investments, linked in with dealing, isn't it? You're managing portfolios, looking at large amounts of money which are invested for people. Then you've got operating collectives, that's your unit trusts, your OICs, investment trusts. These are collective investments. Again, these are firms that get involved in this area, not the advice, but the actual managing, creating of investments. Again, you need separate permissions for these. The FCA regulate all of these. Over here, you've got advising on investments, of course. You've got to give advice on these things. See how it all is slightly different as well, isn't it? Mortgage lending, that's not advising, that's the lending risk. So that's banks, building societies, specialist lenders. Mortgage lending is a regulated activity. Advising on mortgages, of course, that's the big one. That's the one that mortgage advisors, mortgage brokers, probably you, are really wanting to get involved in. But again, it's a separate permission, as you can see. Consumer credits, that's dealing with other types of lending, which is unsecured effectively as well. The provision of consumer credit, and debt collecting, debt advice, that sort of thing is now a regulated activity. So if you want to get involved in any of these areas, you've got to go to your network or your principal, whoever that is, and they themselves would actually help you to get that permission. So what are the regulated investments then? What products are regulated? These are the activities. Now, the products are slightly different here. Regulated investments we're talking here. So there's a few examples here. First of all, deposits. A deposit or some kind of investment is regulated now. Which of course it should be. Electronic money is regulated. That's dealing with point-of-sale machines and systems as well. Insurance is regulated. We know that has been regulated for quite a few years now. Funeral plans has been regulated for a couple of years now. That's the provision of insurance-based funeral plans. So the co-op and insurance companies, or I should say funeral companies, get involved in that area. Down here, shares and futures. So again, that's a regulated investment across here. Government and other bonds are regulated as well. Collectives, talked about those earlier. Unit trusts and OICs and things. Pensions, of course, is a regulated investment. Mortgage contracts, we know that is a regulated investment, has been since 2004. The last one there, equity release, is a separate regulated product. Now, these are all the different products now that the FCA regulates and authorises firms to get involved in, to deal with, to give advice in. Now, you only may, for example, be involved in mortgage contracts. Now, if you do that, then your market or your business is geared purely around mortgages. Many advisors and wealth managers and mortgage brokers get involved in other areas as well. I'm not saying you should get involved in all of them, but for each of these, you need separate exams. You need exams, for example, for pension transfer advice, for investment advice, of course, insurance, you need exams, mortgage contracts, you need your CMAPs, equity release, you need your ER1s. So there's lots of different exams required for you to get authorised to deal with those investments. And that's how the FCA regulate. That's how they look at the industry in order to get it authorised and cooking on gas, as we say. Now, as an advisor, as a mortgage broker, you've got to take the first steps to get into this marketplace. And many advisors, brokers go into what's called the AR status. Now, this is a quick pick up on that for you, just for a couple of minutes, just to give you a couple of ideas on that one. So let's head over to our whiteboard for a second and give that a good wipe. Now, to get yourself authorised by the FCA, now, PRA, by the way, is for the big, yes, for the banks, insurance companies direct, so we don't tend to worry too much about that. The FCA, of course, as we said there, needs to give you permission in order to trade in various regulated activities. Now, if you wanted to, you could go directly authorised straight to the FCA. So there you are, brand new mortgage broker. Can you get directly authorised directly with the FCA? Well, in theory you can, in practice you can't. It's not going to happen. You haven't got the experience, you haven't got the ability, and the FCA would deem it as too risky. It costs you too much money, too much time. We don't tend to do that. So what we do is we get on the back of what's called a principal. It's a principal as well. Get the spelling right for you. Now, a principal is an existing business that's already authorized with the FCA. This could be a mortgage brokerage, a mortgage firm, an advisor firm. It could be a network set up purely to get authorization with the FCA. But they're already dealing with the FCA. They've already approved the FCA. They've already got their product permissions. They've already got their authorization to trade. And what happens is that you decide to join this principal. Now, you could be employed by them, of course. If it's a mortgage company, a mortgage lender, for example, a bank or building society, you get an employed position. That's dead easy, isn't it? Or you could go in as self-employed. It doesn't really matter. But you would be what's called an AR, an appointed representative of the principal. That's what you are. You're an AR, an appointed representative of that principal who have authorization with the FCA. And that's how the market works. Now, what happens here is that the principal firm takes responsibility for everything that you do. The principal firm, the lender, the network, the broker, takes full responsibility for every single action that you carry out. Therefore, of course, they keep an eye on you. They train you, educate you, coach you. They give you procedures to follow, compliance procedures to follow. They give you a computer system that doesn't let you go off track. Everything's controlled by the principal, because if you do anything wrong, the FCA come down on them as a ton of bricks. That's the AR model, which has been operating since, crikey, 1988, when this thing all kicked off, way back. I mean, I was an AR of the Prudential. I think it was Prudential Insurance Company. I was employed, but I was an AR. The Prudential took responsibility for what I did. Obviously, the Prudential only involved himself in one company's products, but you'll probably want to be whole of market. It all depends on the principal that you choose. Make sure the principal's got all the permissions that you want to evolve into. I talked about segueing your business into wealth management, pensions advice, maybe equity release. So make sure the principal you join has that capacity to do that later, so that you can be educated in that area as well. Because once you've joined a principal as an AR, it's very difficult to get out of it. You can get out of it, but there's fees and there's costs and there's time and there's client issues. So it's best to choose the right one and choose it well. That gives you scope for improvement and expansion as well. That's the AR model. Under scrutiny, by the way, the AR model. The FCA are a bit worried about it. They're a bit worried about the AR model at the moment, because quite a lot of principals are not giving the oversight that they need to do. They're not keeping an eye on ARs. They're not training them as much as they should do. They're not giving them the coaching, the education, the support. Because some just don't or can't or won't. You know, money, costs, all sorts of issues, isn't it? So the FCA are on that this year, and they may make some changes to the AR model, but I'll keep you posted. Hey, that finishes my session on FCA authorization. Hope that's been useful. Bye. There you go. Alrighty. So that's just a nice little session there for you. And we haven't even gone online, have we? On air. Ta-da. So that gives you an update on what's happening. Quite a long live stream today, so I wanted to give you some questions and things. We've had the FCA stuff as well come in, so I hope you enjoyed that. Enjoy your week. Have fun. It's it's a good time at the moment in the mortgage sector. It's doing well. Everything's buzzing along nicely. Companies are expanding. Hopefully the weather's getting better where you are. A bit more sunshine up in the sky. It's getting higher, isn't it? You noticed that? Although we've had a couple of storms. We've got Franklin coming over this morning. Eunice, I think it was, in Franklin. It's all very stormy at the moment. But anyway, I hope the weather gets better for you. Enjoy your week, and I'll catch you next week at 12 o'clock. Bye. That's us done for the day. Do you like that little picture? Taken from Portobello Beach in Scotland last weekend. In fact, last Monday, I think it was. A little van there doing coffee. That's us done for the day. I thought that was quite nice.